Mike, should I feel safe?
I'm not so sure. Your neighborhood, where you are, I don't know, man. In Amherst, that'd be the most safe place in the world.
Well, geez, that's not very reassuring. Now I feel even more worried. Hey, I hope the audience doesn't feel the same way, because this is 5 Minute Finance, where we're trying to take stress off your plate. We're trying to lighten the load, make things practical, make them simple, and let you get on with the rest of your life. I'm Matt Robison, and that, of course, is the dulcet-toned Mike Morton, who is our certified financial planning expert. And Mike, you want to help people feel safe?
Yeah. Why when you say certified financial, you pause after certified? You did this last night. You're like certified.
I'm honestly, truly, I'm just fucking with you. I'm just trying to make you nervous, because you just made me feel nervous. You said that in this episode today, you wanted to talk about, are you really safe? Are you sure? And now you've got me all like paranoid and stuff. So turnabout's fair play, man.
Turnabout. All right, fine. This episode, no, you shouldn't feel safe. This is, especially in your index funds. Are index funds really safe? Really?
Oh my gosh. Well, now I don't think they are. Okay, all joking aside, you want to talk about are the things that we think of as safe when it comes to investments. I don't mean like, trapdoors and explosives. I mean, are your safe stock funds really safe? So what are people going to get in this episode?
All right. So in this episode, we're going to highlight, are your index funds safe or not? So we're going to go through what are index funds. That'll be very brief, guys. Why do index funds feel safe? What has changed? What's the risk now? And what this means for you, what to do and what not to do.
I like your whole implication that it's like, if people are saying, wait, what's a stock? Maybe they need a different kind of show. Right. But they may also need to hang on for our listener question, which is all about some jerk who's got a boat. I don't know. This is very, very sus, but you're going to want to hear this about boats. You're going to want to hold on for our worth knowing segment, why context switching is terrible. You've already lost me. And absolutely our one thing at the very end, which is a piece of advice to right click. Boy, this is all absolutely impenetrable to me. And it's creating a real curiosity that I hope our whole audience shares.
Yeah, I love the click. It's like, podcasts, let's double click on that for a minute. No, we're right clicking.
We're right clicking. Is that like swiping right?
I don't know. I refuse. I will not engage in the swiping right or left, because I don't know which is which. And so let's just move on. I don't know
which is which either. Oh my gosh, that's amazing. I think swiping right is good. So let's swipe right on the rest of this episode before everyone swipes left on us. Let's get to it. All right. First of all, in brief, as threatened, what are index funds?
As threatened, index funds are mutual funds or ETFs, a single fund that holds a basket of stuff that follows an index. So someone creates an index, and then multiple companies might have funds or ETF versions that follow that index. So classic ones like the S&P 500, the top 500 biggest companies in the US. That's a pretty easy thing to look up. What are they? So that's an index. And then a fund that tracks that, the Fidelity S&P 500 or the Vanguard S&P 500, buys all 500 of those companies. So you can just buy that one single fund and own all 500 companies.
So just a big portfolio, a big basket of companies, a lot of averaging. I never realized until you told me that the Dow Jones is not a big index. It's like a very tiny number of companies.
Yeah, it's like 30 companies. It's really small.
It's really distressing. It's like picking up a few leaves and describing the forest. Not great.
Well, look great, Matt. That's exactly what we're talking about today. Is your index fund diversified and safe?
Oh, what if I picked up only, I don't know, oaks?
That's right.
Yeah. You know what? Exactly. I'm not an arborist, so I'm going to drop this metaphor now. All right. Why do index funds feel safe? I mean, We've devoted a lot of time to telling people get into low cost index funds. It's safe. It's free. I mean, they feel safe. I think they're safe.
Yeah. It's exactly right. They feel safe because that's what we've been telling you. And that's what you've read your entire career, your entire life. It's like, oh, low cost index funds. That's what you should buy. They're the best thing for you. So that's why they feel safe. And we've been lied. No, we have not been lied, Matt.
Oh, good.
We haven't gotten to that part yet.
Okay, good.
That's why they feel safe. Of course, you've been told it many times and you're invested in them, in your 401k. They hold thousands of companies, like you just said, hey, the S&P 500 has 500 different companies. They're not going to all go bankrupt. So you own a lot of different companies and they're usually following an index that's not active. And so, we kind of agree with, we should use, not actively managed funds. So they're low cost and index based funds. And so, yeah, they feel great.
So part of the safety comes from that diversification across many different investments that are part of the fund. It's like in the year 2001, if you were invested solely in Enron, you were subject to some risk. If you're invested in 500 companies, they're not all going to Enron on you at once.
That's correct. And, that's one of the only free lunches, as they like to say, on Wall Street is being diversified. And I would add to that the low cost. The only thing that's been proven to be relational to your returns. Okay. So the only thing that what's a stat I could use or something a metric I can pull out so I get better returns. The only one they've correlated is the cost of whatever you invest in. So that's why low cost and massively diversified are the two things we really preach.
Right. Not actively managed. You're not losing out on fees. Okay. There's clearly a twist in here. And I was unaware that there was a twist in this story that I've been telling alongside you for a long time here. What's the twist?
Yeah, the twist is, and this was brought to my attention by a great friend of ours and a reader and follower of the podcast. And she forwarded me a New York Times article. So it's definitely in the news, Matt, which I thought we would talk about. What has changed recently? The twist is that the big companies have gotten bigger. All right, we all know they're crossing the $4 trillion mark. We got NVIDIA, Apple, Microsoft, all these
the Mag 7 types.
The massively massive companies have just gotten bigger and bigger and bigger. And then you're like, okay, wow, that's fascinating. But what it means is they are taking up more of the index. Okay, because remember the index. So let's talk about the S&P 500, the top 500 companies. Okay,
right.
Well, the biggest ones take more of your dollars. Okay, so it's called cap weighted. So when you invest $1,000 into the S&P 500, you own 500 companies, but you don't own a couple bucks of each. Okay, you don't own $2 of each 500. You invested $1,000. You do not own $2 of each. You own like $6 or $7 of NVIDIA. $5 or $6 of Apple, $5 or $6 of Microsoft. And then the lower companies all the way at the other end, you own just, a few pennies. Oh. So you own more of the bigger companies. It's called cap weighted. I
never knew that. Wow. Okay. I really thought it was just like evenly distributed, like oatmeal.
Why is oatmeal evenly distributed?
Because it's a gruel, man. I thought my index funds were a gruel. About as tasty, frankly. About as tasty,
yeah. They're not too tasty. No, it's called market cap weighted. So basically all index funds, you own more of the bigger companies. And so getting back to today, the massive companies are getting more massive. All right. So roughly the 25% of that S&P 500 is just in 5 or 6 companies. So 1/4 of your $1,000, $250 is invested in just a handful of companies.
So it's not quite my very dated at this point Enron example, not exactly. But if you're talking about a handful of companies, especially when they're really concentrated in one sector, it is a little bit more vulnerable to something that could affect one sector.
That's exactly right. I mean, you got it. That's why
the AI bubble could pop, and all of a sudden, all of them are like in a bit of a nosedive, and so is your index.
That's right. So you can imagine, Walmart, where I'm getting my supplies, I'm still going there. They're still doing fine, but all these massive companies have taken a hit. And so my index fund drops by 50%, even though half the companies are still doing fine.
So what do we do? What do we do if we've gotten overweighted?
Yeah. And all right, let's think about this. So wait, first, this is a problem, right? Like we just said, wow, I didn't even know, that I get 25%. This has happened, Matt, multiple times before. So that's the first thing to realize. Like, this is not a new phenomenon. This is not like out of the blue. This time is very different. So out of the 100, we look at historical perspectives for investing out of the last 100 years of investing. This was very common in the mid 20th century, in the 1900s. Very few companies were kind of dominating. And so this was pretty common. So it's not extraordinary. It's not like this time is totally different. And in fact, it reminded me just 2 years ago, there was a lot of news around this. And a friend of mine, Ben Carlson, on the Wealth of Common Sense blog, he wrote, this is exactly 2 years ago. We're now looking at 1/3 of the index. This is the US stock market index in the top 10 names alone. And if we broaden to the top 25 holdings, they make up almost 50% of the index. So the top 25 companies were dominating like half of the index. And that was just 2 years ago.
Yeah, that is reassuring because just because it can be a problem because there's more risk than we realized, it doesn't mean there will be a problem. It just means, because we've gone through this before.
Yep. That's exactly right. So now we know we have some concentration risk. So now we just know we're more informed, right? Hey, I've got this index funds. I hold the S&P 500 and wow, I actually hold quite a lot of these 5 or 10 companies, right at the top. So it's good to be aware of that. So what is this, what to do? Basically, on the one hand, nothing. This has happened many times before.
I don't like that answer.
You don't like that answer? All right, I got more answers for you.
You just told me that I'm out on a ledge and it's like, you stay there.
It'd probably be fun.
Thanks. How about a parachute?
You want a parachute? Okay.
Yes, man.
All right. A put option on the S&P 500. That's what you should do. That's your parachute.
Oh, yeah, that's too sophisticated.
Yeah, exactly. That's not a 5-minute task.
No.
You'll be doing that.
I know what you mean, but no.
Yeah. So listen, we do need to evaluate your portfolio. All right. So now we know we've got concentrated position. We're holding the S&P 500 or the total US stock market. First, there's a big difference between those two. So I've been using them so far kind of interchangeably. The S&P 500, the top 500 companies. The total US stock market is over 2,000 to 3,000 companies. Now, many of them small. So when you own the cap weighted, remember it's cap weighted. So the top 500 are going to dominate it. But if you own the total US stock market, about 80% of your money is in the top 500. The other 20% will be in that long tail of a couple thousand companies. But that's 20% more diversified, right?
Yeah,
You're no longer 100% in the top 500, only 80%. So that's why when I do portfolios, I always use total US stock market, not the S&P 500. And you mentioned earlier, like the Dow Jones, that's only like 30 companies. So no, we want to use the more diversified. So in your investments, use total US stock market.
Is there like a shorthand for that? Can I like look it up if I'm on Fidelity or Vanguard? Or
just use those words. Total US stock market. So don't look for the SP 500. Total US stock market. Fidelity, Vanguard, Schwab, they all have a fund. And then you can look number of holdings is what you're looking for. Should be in the thousands.
Got it. So this is literally a matter of if this resonates for you, if you're a little concerned about this, you can just look into it.
Oh, yeah, absolutely. I mean, there's a couple of things to be on the lookout for. That's one. But let me go back to the concentration risk. Now we know more of our dollars are in these big companies. The other thing I would consider is what other investments do you have in those same companies? Do you work in the tech sector or the AI? Do you have RSUs and stock options in some of these same companies? Like, oh yeah, I do. I work for Apple. I got a bunch of Apple stock and I own the total US stock market. Well, that's another 6% Apple. So there's something you might want to consider if you've got some gains in stocks you don't want to sell, like you have some concentrated positions in some of these. Maybe you own a tech fund. Hey, I thought tech was great 10 years ago. So I bought a technology fund. It's done fantastic. Congratulations. And now you're even more overweight, in technology. So you want to round out your investments knowing that the index is pretty heavily weighted.
Great. So now we're telling people that not only are they at risk, they're fat. I think you could also broaden your point, though, to say that if you're not in some index fund at all right now, you're very likely overconcentrated unless you're sort of manually constructing an index fund by very carefully selecting, a broad range of investments yourself and like manually assembling it. The first step might be, well, get into a broad index fund. And then the second one is, well, just check out, are you in the S&P 500 or are you in the full range of the stock market?
Yeah. So let's diversify there. First of all, let's say what not to do, Matt. Don't dump your index funds. Don't get out of low-cost index funds. They're still great. They're wonderful. I think they're still the best place to invest. So keep your low-cost index funds, but you might need to broaden them. One place I've been talking about forever with you as well is the international markets. We tend to be underweight. We have a home bias like everyone else in the world. You invest more in your home country than in outside countries. Now recall, the US versus the rest of the world, the US is about 60% of the global investable market. That means 40% is in other countries like Europe and Australia and Asia. So you can invest in those. And if you want to take the global view, you'd have 60% US and 40% in the rest. And I guarantee you, very few listeners have even 20% of the rest, let alone 40. So that's a great place to diversify.
Well, first of all, I like hearing that I'm underweight as opposed to overweight 100% of the time. I will say that, if you're like me, a former federal employee, a current federal employee, that applies to a lot of us, and you have anything in the thrift savings plan, they make it super duper easy to select one of their like prefabbed funds. And I actually did put, I want to say it was 20% into international way back in the day. And I want to do places like Fidelity, Vanguard, do they make it easy to do that, to select an option where you can just apportion some to international or small cap?
Absolutely. So you can do total international market, and it's going to be or sometimes they're called ex-US. So everything not the US. So Vanguard has a VXUS. That's everything that's not US. And that's great, Matt. So you just highlight exactly what I said. You put 20% in the international, right? Even though historically it's like 40 to 50% is what the investable market is. Now, good for you. The US market has done really well the last 20 years compared to the rest of the world. Typically it's like 50-50, but I told you US is closer to 60 now. So it's just done better here. But now might be a time, that you really want to look at those international markets.
Well, I'd always rather be lucky than good. So I guess that apportionment worked out for me, but it was not because of any of my foresight. All right. So just to bottom line this, it sounds like this is actually legit a 5-minute test. This is really not that hard. You need to just find out. Are you in the more narrow set of index funds? I mean, first of all, if you're not in index funds at all and you haven't done that manual like diversification, get a little bit more diverse, people. Not sound woke or anything, but get a little bit more diverse. And then you can just check, are you in the narrower slice or are you truly in the broad all US stock market or internationally diversified?
Yep. That's it, man. That's exactly what I would do. I would just take a look at that, like you just said, and switch your mindset from, hey, I'm in index funds, I'm totally safe, to, hey, what risks might I be taking that I'm not realizing?
Right.
And start thinking about
there's no such thing as risk-free, right? Like 10 miles per hour is safer than 60 miles per hour. But the only truly safe thing is never get in the car, which means you're never going anywhere.
There you go.
Deep. I know. Hey, speaking of deep, let's get to our listener question. All right. This week's listener question, I didn't mean to malign earlier at the top of the show, the asker of this question. I just, look, I don't come from a notably nautical people. The ocean frightens me. It seems terrible. Like, first of all, I didn't even understand swimming. My son is like a very high level swimmer. I think swimming is the kind of thing you should do only if you've fallen off of a boat. And I don't think you should ever get on a boat. So I don't really relate to this listener's question, but I can see why it is relevant. The listener asks, my dad wants to give me his boat. First of all, I'd like to ask you, do you live close to water? Like, is this going to be useful to you? But beyond that, the rest of the question is there any tax-related issue I need to be aware of?
Any tax-related issue to getting a gift from dad? So any one person can give any other one person $19,000 in this year, 2026, with no tax implications, called under the year. That's the yearly gift limit. So I can give Matt $19,000 and I don't have to file anything. He doesn't have to file anything and no one owes any tax. If you go above the 19,000 from one person to one person, then you have to file a gift tax return. You have given away, okay, so you have to file a gift tax return. It does not mean you owe tax. You have to file a gift tax return. So if I give Matt $20,000, I have to file a gift tax return and say I gave him $1,000 more than the yearly limit. In your lifetime and at death, you can give away $15 million with no federal tax owed. In your lifetime and at death combined. It's one combination. So everything I own when I die that's getting given away, because I'm no longer around, plus everything I've given away over the yearly limit, that's got to be less than 15 million. Otherwise, you start owing tax. Okay? So let's get back to the boat. I know a little bit more about the boat. The boat was over $19,000. Okay? So dad would have to file a gift tax return. However, often you have two parents giving. They can combine the gifts. So you can combine gifts. So two parents, right, can give $38,000. Now I should say cash or just how much it's worth. So in the boat, we got to say how much is it worth. Okay, same thing, right? If you're going to give stock, if you're going to give cash, if you're going to give a boat, okay, it's a gift. So now you can do $38,000 if both parents are still alive, if both parents own the boat and they're giving it to one child. But what if the child's married? Okay, both parents own the boat jointly. And they're going to give it to their son plus the son's spouse jointly. So now it's 4 times 19,000, right? Both parents can give to both. So now you can go up to almost $80,000 with no taxes owed and no gift tax return needing to file.
Let's get to our worth knowing segment. All right. Worth knowing. These are so inscrutable to me. You want to explain why context switching is terrible.
All
I'm already lost. I've lost context.
I've lost the context and we had to switch. In fact, we switched around the one thing in the worth knowing.
So what's happening?
Context switching is terrible. So that's when you're switching. We know this, right? Everyone knows this, listeners. Like, switching from task to task really slows you down, takes 15 minutes to get back in the groove and all that stuff.
Right.
So like do one task at a time. Yes. This was fascinating. This is a worth knowing, Matt. Okay, Matt, how fast can you count? Don't do it, please. Out loud right now on the podcast, but just answer the question. How fast do you think you can count from 1 to 26?
I would guess I could do it like half a second per number. So let's say 13 seconds.
All right. How fast can you go from A to Z? Can you go in order from A to Z? Say in the alphabet.
I'm not that fast. I don't know. 8 seconds.
All right. The average for these, Matt, you're a little bit above or below average, above number-wise. We'll just call you above average, okay? 4 to 5 seconds.
Is this like how I'm underweight?
Yeah, exactly. So 4 to 5 seconds the average, right? Oh, I can count to 1 to 26, no problem. A to Z, like I got this down. Now, Matt, I want you to go like this. 1A, 2B, 3C, all the way through 26. How long do you think that would take you?
We don't have enough time.
We don't have enough time. So most of the test subjects didn't even finish, couldn't even like make it through. And if you do, it's like 1 or 2 minutes. Okay. 20 times. So things that are in context that are flowing, obviously you can just do like super fast, but when you got to keep switching, your mind just cannot keep up. I found that fascinating, how context switching we know is terrible. And there's a great example. So try that at home.
All right. With that, let's get to our one thing. This one thing is as confusing to me as what was ultimately worth knowing. The only note you gave me on this is right click on the Mac. This sounds like a dance move that I'm never going to learn. What is right click on the Mac?
Right click on the Mac. It's not swiping right or left, which neither of us understands. I blew my friend's mind, and I'm totally going to out her on the podcast. This is our marketing friend, Julie, who produces this entire podcast. So Matt and I do record it. It's not AI voices, but my friend Julie does all the other amazing work behind the scenes. And I was chatting with her recently, and I was like, she's like, oh, how do you do this thing on the computer? And I was like, oh, you just right click and then choose this. She's like, and she looked down like at her MacBook. You know, there's clearly no right button here. I was like, no, you just take 2 fingers on your pad, on the keypad, and you press them 2 fingers, and that brings up the right click menu. And she did it, and and it was just silence for like, you know, a little bit. She's like, what?
Oh my gosh.
I never knew you could do that.
That's really useful. I don't use Macs, but I can see how for a proportion of the population.
You go. So I'm hoping I just blew someone else's mind out there listening to this. Like, wait, what? You can do that?
Well, it's good to know because I operate in a PC environment. And so, you know, like I would not have ever known that. All right. You know what? That was index funds, right-clicking, 50 things, and context switching. I'm lost. I'm completely lost. We're going to have to end it here. For Mike, I'm Matt. We'll see you next time.
Thanks, Matt. Thanks for joining us on 5 Minute Finance. If you like what you heard, please subscribe to and rate the podcast. It makes a huge difference for my show. You want more? Find Morton FA on Substack. If you have a comment or question, please email pod@mortonfa.com. Until next time, thanks for tuning in. This recording is for informational purposes only and should not be considered for investment advice. Opinions expressed are as of the date of recording. Such opinions are subject to change. I cannot guarantee the accuracy or completeness of the data presented here.